If you have been watching the news this week and felt a knot in your stomach about your retirement savings, I need you to hear something. That feeling you have right now, that anxiety about oil prices and your portfolio, it is completely understandable. But it is also the exact feeling that leads people to make the most expensive financial mistakes of their lives. And today, I am going to show you why what is happening in the Middle East matters for your money, but probably not in the way you think. More importantly, I am going to give you a simple framework to protect your retirement savings without making a single panicked decision. Here is what is going on. In the last week, oil prices have jumped roughly 12%. Brent crude, the international benchmark, settled above $81 a barrel. That is a real move. You feel it at the gas pump. You will feel it at the grocery store in the coming weeks. And if you are retired or close to retirement, you are probably looking at your brokerage account and wondering if you should do something dramatic. But before you pick up the phone and tell your advisor to sell everything, let me share something that might surprise you. Since 1991, there have been 3 major military conflicts involving the Middle East and large oil-producing nations: the Gulf War, the Iraq War, and the 2025 strikes on Iran nuclear facilities. In every single case, the stock market posted gains within 1 month after the conflict began, and those gains held for at least a year. Every single time, oil prices spiked in each case, and in each case, they came back down within 3 months. Now, does that mean this time will be exactly the same? No, nobody can guarantee that. But it does mean that the historical pattern is overwhelmingly on the side of patience, not panic. So let me explain what is actually happening right now and why it matters for your specific financial situation. Think of the global oil market like a highway system. Normally, traffic flows smoothly through multiple routes. But the Strait of Hormuz, a narrow waterway on Iran's southern border, is like a single bridge that carries about 20% of all the world oil and natural gas. Right now, roughly 150 ships are anchored in that waterway. Traffic is backed up. Iraq, the second largest oil producer in OPEC, has cut production by about 1.5 million barrels per day. Qatar, one of the biggest natural gas exporters in the world, halted gas production entirely after military strikes hit its facilities. Saudi Arabia paused a refinery after a drone attack. That sounds terrifying. And here is where most financial commentary stops. They tell you the scary part and leave you hanging. But I am not going to do that. Because understanding the problem is only 10% of what you need. The other 90% is understanding what you can actually do about it. Now here is the part most people miss. Goldman Sachs, one of the largest investment banks in the world, estimates that roughly $14 per barrel of the current oil price is what they call a risk premium. That means the market is not pricing oil based purely on supply and demand. It is pricing in fear. And fear premiums, by definition, shrink as uncertainty fades. Goldman Sachs also estimates that even a full 4-week shutdown of the Strait of Hormuz, the worst-case scenario, would only justify that $14 premium. And if only half the flows are disrupted, the premium drops to about $4 per barrel. In other words, the market has already priced in a very bad outcome. That does not mean things cannot get worse. But it means a lot of the pain is already baked into today's prices. Does this sound familiar? It should, because we saw the exact same pattern in March of 2022 when Russia invaded Ukraine. Oil spiked to $133 a barrel. The S&P 500 dropped more than 7% in a few weeks. And you know what happened next? Just over a month later, the stock market had rebounded above its pre-invasion level. Oil eventually came back down too. The people who panicked and sold locked in their losses. The people who stayed patient kept their money working for them. And this is where it gets really interesting. Because the current oil price of $81 is far below that 2022 peak of $133. We are not even close to the kind of energy shock that happened 4 years ago. BlackRock, the world's largest asset manager, views these events primarily as a volatility shock, not a fundamental economic shift. That is an important distinction. Volatility means prices bounce around. A fundamental shift means the rules have changed permanently. The evidence so far points to volatility, not a permanent change. But here is the catch. Even though the stock market tends to recover from these events, The impact on your daily budget is real and immediate. Let me give you some specific numbers. If you drive 800 miles a month and your car gets 30 miles per gallon, you use about 27 gallons of gas. If prices go from $3.20 to $3.85 per gallon, that is an extra $18 per month. Over a year, that adds up to about $216 more just for gasoline. Now add in grocery inflation. When energy costs rise, transportation costs rise, and food prices follow within 2 to 4 months. Estimates suggest energy-sensitive grocery items could see 5 to 8% inflation. For a household spending $500 a month on groceries, that is an extra $25 to $40 per month, or $300 to $480 per year. Combined with higher gas costs, you could be looking at an extra $500 to $800 in annual expenses. That is real money, but it is also manageable money if you plan for it. Quick question: what would you do if I told you there was a simple way to protect both your daily budget and your long-term retirement savings at the same time? That is exactly what I want to show you next. It is called the bucket strategy, and it is one of the most powerful frameworks for retirees navigating uncertain times. Here is how it works. Imagine your retirement savings split into 3 buckets. Bucket 1 is your immediate needs bucket. This covers the next 0 to 2 years. It holds cash, certificates of deposit, and money market funds. This is the money you live on day to day. It pays for groceries, gas, utilities, and your required minimum distributions. Because it is in cash and short-term instruments, market volatility does not touch it. Whether stocks go up 10% or down 20%, your Bucket 1 does not move. Bucket 2 is your bridge bucket, covering years 3 through 7. This holds short to intermediate term bonds, Treasury inflation-protected securities, which adjust their value based on inflation, and possibly I-bonds. This bucket provides moderate growth and, crucially, inflation protection. When gas and grocery prices rise, your tips adjust upward to help compensate. Bucket 3 is your long-term growth bucket, for money you will not need for 8 or more years. This holds diversified stocks, including broad-based index funds. This is where your money grows over time to keep up with decades of inflation and living expenses. I want you to really think about this next part. Let me show you exactly how this plays out with real numbers. Meet Maria. She is 68 years old with $500,000 in her retirement account. She needs to take a $25,000 required minimum distribution this year. In the first scenario, Maria does not use the bucket strategy. She has 70% stocks and 30% bonds, all mixed together. The market drops 15% during the conflict escalation. Her portfolio falls to roughly $447,500. She needs $25,000 for her required distribution, so she sells stocks at depressed prices. Here is the problem. If the market later recovers 15%, she misses the full recovery on that $25,000 she already sold. The estimated permanent loss from that forced sale is about $3,750, and that is just from 1 year. If she has to do this again next year during another downturn, the losses compound. But there is an even worse trap hiding here. If Maria decides she cannot stomach selling at a loss and skips her required minimum distribution, the IRS hits her with a 25% excise tax on the amount she did not withdraw. On $25,000, that is a $6,250 penalty. It is a genuine no-win scenario if you are not prepared. Now let us look at the second scenario. Maria uses the bucket strategy. She keeps $50,000 in cash and money market funds as Bucket 1, $150,000 in bonds and tips as Bucket 2, and $300,000 in diversified stocks as Bucket 3. The same 15% market decline hits. Her stocks drop to $255,000. But here is the difference. She takes her $25,000 distribution entirely from Bucket 1, her cash. She does not sell a single share of stock. When the market recovers, her full $300,000 equity allocation participates in the upswing. No forced selling, no locked-in losses, no IRS penalty. The difference between these two scenarios could be worth tens of thousands of dollars over the course of retirement. And all it requires is organizing your money differently. Not more money, Not better stock picks, just better structure. Okay, here is where it gets practical. I have 7 things you can do starting today. You do not need a financial degree. You do not need to make a single trade this week. You just need to take these steps calmly and methodically. First, check your portfolio allocation today. Log into your brokerage account or call your advisor and confirm exactly what percentage is in stocks, bonds, and cash. Write those numbers down. Second, calculate how much cash you need for the next 12 to 24 months. Add up your monthly expenses, subtract any income you receive from Social Security or pensions, and multiply the remainder by 24. That is your bucket 1 target. Third, review where your required minimum distribution will come from this year. Make sure you can take it from cash or bond holdings without being forced to sell stocks at the wrong time. Fourth, calculate your personal energy budget exposure. Add up your monthly spending on gasoline, electricity, heating oil, and natural gas. Know your exact number so you can plan for a 10 to 20% increase over the next few months. Fifth, call your utility company and ask about budget billing programs. These programs average your energy costs across 12 months, so you pay the same amount every month, even when prices spike. It takes 5 minutes and can save you from budget surprises. Sixth, set up a 24-hour rule for yourself. Starting today, do not make any financial decision. No trades, no purchases over $500, no responses to any offer, until you have slept on it for at least 1 full night. This single rule prevents more costly mistakes than any investment strategy ever invented. Seventh, call your brokerage firm and designate a trusted contact on your account. This is someone the firm can reach if they suspect something unusual is happening with your money. It is not giving that person access to your account. It is an extra pair of eyes protecting you. Now let me talk about something critically important. Because every time there is a crisis like this, the scammers come out in force. And I need you to be ready. Here are the red flags you must watch for. If someone calls you out of the blue and says you need to move your retirement money immediately because of the Middle East conflict, that is a scam. Legitimate advisors do not cold call with urgency-based pitches. If you receive an email claiming to be from an airline offering a refund for canceled flights due to the conflict, and it asks you to click a link and enter your bank information, that is a phishing scam. Airlines send refunds through original payment methods, not through email links. If someone invites you to a free lunch or dinner seminar promising to teach you how to war-proof your retirement, be very cautious. The CFTC warns that many of these seminars are fronts for selling overpriced gold coins or fraudulent investments. The sellers charge extreme markups and buyers rarely see a profit. If you see social media posts from so-called financial experts claiming special knowledge about which oil stocks or defense stocks will skyrocket, ignore them. Unsolicited investment advice on social media is one of the biggest fraud vectors targeting seniors today. If anyone tells you that gold is the only safe investment and you need to convert your retirement savings immediately, walk away. While gold can be a reasonable part of a diversified portfolio, typically 5 to 10%, anyone who says it is the only answer is trying to sell you something. If anyone says the words guaranteed returns or risk-free investment, that is always a red flag. No investment is guaranteed. No investment is risk-free. Anyone who says otherwise is either lying or misinformed. If someone pressures you by saying this offer expires today or prices will double tomorrow, that is manufactured urgency designed to bypass your good judgment. Here are 3 things you can say to shut down any high-pressure pitch. Number 1, say, I never make financial decisions on the spot. I will review this with my family and my advisor. Number 2, say, please send me everything in writing. I will look it over when I am ready. Number 3, say, I am going to independently verify everything you have told me before I take any action. And if you have already clicked a suspicious link or sent money to someone you now suspect is a scammer, do these things immediately. Call your bank and request a freeze on recent transactions. Change your passwords on all financial accounts. Report the incident to the FTC at reportfraud.ftc.gov. Place a credit freeze at all 3 bureaus, Equifax, Experian, and TransUnion. And tell someone you trust what happened, because isolation is what scammers count on. Let me bring it all together with the 3 things I want you to remember from today. Number 1. Oil price spikes from geopolitical conflicts have historically been short-lived, and markets have recovered within months every time since 1991. Number 2. The bucket strategy, keeping 1 to 2 years of expenses in cash, protects you from forced selling during downturns and eliminates the RMD trap. Number 3. A 24-hour rule on all financial decisions is your single best defense against both market panic and scam artists. Now, if you are watching this with a family member, or if you are a son or daughter watching this because you are worried about your parents, let me speak to you for a moment. The best thing you can do is have a calm, respectful conversation. Not a lecture, a conversation. Ask open-ended questions like these. How are you feeling about everything going on in the news right now? Do you feel comfortable with where your retirement savings are? Is there anything about your finances that has been keeping you up at night? Listen more than you talk. Do not try to take over their finances. Do not make them feel like they cannot handle things on their own. And please, never use shame or fear to motivate action. Nobody makes good financial decisions when they feel embarrassed or panicked. What you can do is offer to sit with them while they review their accounts. Offer to help them set up that trusted contact on their brokerage account. And gently suggest the 24-hour rule if they mention wanting to make a big financial move. Let me repeat those 3 key takeaways one more time, because they are worth hearing twice. Number 1. Oil price spikes from geopolitical conflicts have historically been short-lived, and markets have recovered within months every time since 1991. Number 2. The bucket strategy, keeping 1 to 2 years of expenses in cash, protects you from forced selling during downturns and eliminates the RMD trap. Number 3. A 24-hour rule on all financial decisions is your single best defense against both market panic and scam artists. Here is the core idea I want you to take away from today. You cannot control what happens in the Middle East. You cannot control oil prices. You cannot control the stock market. But you can control how your money is organized. You can control whether you have cash set aside for the next 2 years. You can control whether you fall for a scammer pitch or hang up the phone. And you can control whether you make decisions from a place of calm planning or a place of fear. This is general education, not personal financial advice. Your situation is unique, and I strongly encourage you to consult with a licensed financial advisor before making any changes to your portfolio. If you want to verify any information I shared today, check it independently through trusted sources like the SEC at investor.gov, the Social Security Administration at ssa.gov, or FINRA broker check at brokercheck.finra.org. If you found this helpful, save it so you can come back to it when the next headline makes you nervous. Share it with someone you care about, because the best financial decisions are not made in moments of crisis. They are made in moments of preparation. And that is exactly what you just did by watching this. Stay calm, stay informed, and stay in control of your money.